Good day, investors. In this video, we will take a closer look at Nokia. The company reported their Q2 earnings, and the results were solid. Net sales grew 9% on a constant currency basis, comparable margins expanded, and AI and cloud demand exploded. This was a quarter of clear acceleration, especially in AI and cloud, with solid progress across Nokia's 5 strategic priorities. So in this video, we will look at the earnings in detail. Then we will look at the valuation, and finally, I will give you my personal take on why I think Nokia stock could be a good pick for your portfolio. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. Let's start with the numbers. Nokia delivered net sales of 4.8 billion euros in Q2, up 9% year-on-year on a constant currency basis. Comparable gross margin rose 70 basis points to 46%, and comparable operating margin also improved 70 basis points to 9%. The real standout was AI and cloud. Net sales to AI and cloud customers more than doubled, up 105%, and order intake hit 2.8 billion euros in a single quarter. Management said roughly half of those orders should convert to revenue over the next 12 months. Network infrastructure was Nokia's strongest segment this quarter. Optical networks grew 20% to 868 million euros, and IP networks rose 16% to 679 million euros, both driven by strong demand from AI and cloud customers. Fixed networks was slightly down 2%. Overall, the segment delivered 12% growth. Gross margin expanded 240 basis points to 42.7%. And operating margin improved 170 basis points to 8.1%. You can clearly see the strong recovery and improving profitability on the charts. And moving to mobile infrastructure, which also delivered solid growth this quarter. Overall net sales rose 7%. Radio networks, the largest part of the business, grew 7% to 1.765 billion euros. Technology standards, Nokia's patent licensing business, performed strongly with 15% growth, while core software was roughly flat, up 1%. Gross margin came in at a healthy 49.3%, although that was down 70 basis points year-on-year, and operating margin was 11.6%, down 60 basis points. So while margins softened slightly, the top-line growth remained resilient, showing continued momentum in this segment as well. Looking at sales by customer type, you can clearly see where the growth came from. AI and cloud was the biggest driver, growing 105%. Telecom customers grew a solid 4%, and technology licensees, the patent business, rose 15%. Mission-critical enterprise and defense was slightly down 3%. Overall, this brought Nokia from 4.4 billion euros in Q2 last year to 4.8 billion euros this year, a 9% constant currency increase, driven especially by the very strong growth in AI and cloud, showing that the company is well positioned to benefit from the ongoing AI infrastructure build-out. And moving on to cash flow. Working capital increased significantly this quarter. This was mainly driven by employee incentive payments related to 2025 and some additional working capital investment to support the strong growth, especially in AI and cloud. Receivables were up 280 million, inventories 370 million, and liabilities 330 million, resulting in a total net working capital outflow of almost 1 billion euros. On top of that, Nokia paid 0.2 billion euros in dividends. As a result, free cash flow came in negative at 0.7 billion euros, and net cash declined from 3.8 billion euros at the end of Q1 to 2.8 billion euros at the end of Q2, indicating that the company is investing heavily into growth and scaling its AI and cloud business. Now, when looking at their forward outlook, we can see that Nokia has raised its full-year comparable operating profit guidance to a range of 2.1 to 2.6 billion euros, a technical increase from the previous range. For the second half, they expect net sales to grow 3% to 7% sequentially in Q3, while comparable operating profit should stay roughly flat from Q2 into Q3 due to the timing of software revenue. They then expect a meaningful step up in Q4. Other key assumptions include capital expenditures of 800 to 900 million euros and free cash flow conversion of 55% to 75% of comparable operating profit. Overall, management remains constructive on the rest of the year. Now, when we look at Nokia's growth strategy going forward, we can see the company is well positioned for the AI opportunity. They have 5 clear strategic priorities. First, accelerate growth in AI and cloud, where they already delivered 105% sales growth and 2.8 billion euros in order intake this quarter. Second, lead the next era of connectivity with AI native networks and 6G, highlighted by the new AI RAN platform that offers double the spectral efficiency and evolves at software speed. Third, grow by co-innovating with customers and partners, including partnerships with Google Cloud, Vodafone, and Indosat. Fourth, focus capital where they can differentiate, for example by selling the FWA business and expanding optical manufacturing in the US. And fifth, unlock sustainable returns through internal AI adoption and accelerated restructuring. Overall, the strategy is clear, and the execution in Q2 shows they are already making solid progress. Now, when looking at Nokia's growth potential, one of the most interesting developments is the new AI RAN platform. They position it as the next platform of the RAN industry. First, it can deliver twice the network capacity from the spectrum operators already own. Second, the RAN can now evolve at software speed instead of silicon speed, without the need for hardware upgrades. Third, it's open and programmable, turning the RAN into a true platform ready for the AI era. Fourth, there are 3 flexible deployment paths on one AI RAN platform, with no forklift replacement needed, all leading toward the same 6G destination. And fifth, it offers a leap in total cost of ownership and power efficiency at no hardware premium. This is Nokia's clear bet on making radio networks more software-defined and AI native. So after looking at the earnings and growth potential, let's now look at the valuation and analyst ratings. According to stock analysis data, 11 analysts currently give Nokia a consensus rating of buy. The average 12-month price target is $15.21, which implies more than 56% upside from current levels. The highest target stands at $21, representing over 115% upside, while the lowest is $8.50. As you can see on the chart, after a strong run over the past year, the stock has pulled back recently. However, the overall analyst consensus remains constructive and sees meaningful upside potential over the next 12 months if Nokia continues to execute on its AI and cloud strategy. Now, when we look at the stock performance from stock analysis, we can see that Nokia is currently trading at $9.73, down about 5.3% on the day after the earnings release. Despite the short-term pullback, the stock is still up more than 118% over the past year. The market capitalization currently stands at around $55.4 billion. Looking at the key valuation metrics, the trailing PE ratio is elevated at 68.5 due to restructuring charges, but the forward PE sits at a more reasonable 22.5. Analysts maintain a buy rating with an average price target of $15.21, implying over 56% upside from current levels. Overall, after a very strong run, the stock has cooled off recently, which could present an interesting entry point if the AI and cloud momentum continues. Now, in conclusion, I think Nokia offers an interesting opportunity at current levels. The company is clearly executing on its AI and cloud strategy, with very strong order intake and improving margins in network infrastructure. The new AI RAN platform also shows they are thinking long-term about the next generation of networks. Valuation is no longer cheap on a trailing basis, but the forward multiple looks more reasonable, and analysts still see meaningful upside. There are risks, including working capital pressure and execution on the AI ramp, but for investors who believe in the multi-year AI infrastructure build-out, Nokia looks well-positioned in my opinion. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.